One of the most common areas where earnings management and fraud occurs is revenue recognition. It can take the form of recording revenue too early before sales final, to creating fictitious sales, or even channel stuffing, where companies ship excessive products to distributors just before the end of a reporting period to inflate revenue. In this video, we'll take a closer look at revenue recognition guidance historically, the issues it was supposed to address, and how we ultimately arrived at ASC 606, revenue from contracts with customers. It's important for you to understand revenue recognition standards because you need to be able to spot when companies don't record revenue properly and the impact it has on the accuracy of the financial statements. Before the 1930s, the concept of realization, conservatism, and the cost accounting proof delivery concept were used. And the matching concept attempted to match revenue with related expenses. That was not a formalized rule and it ended up leading to earnings smoothing. Industry customs also developed that created accounting problems that eventually forced reform. For instance, the railroads and utility companies would recognize revenue from long-term contracts based on the engineer's estimates, which created opportunities for manipulation. Ambiguous contracts and manufacturing companies would recognize revenue when customers ordered, and publishing companies frequently recognized revenue before the sale to the customer was finalized. In banking and insurance, accountants use complex rules based on accrual schedules with little standardization. In short, there were no formal authoritative rules, and this lack of standardization contributed to widespread earnings manipulation and ultimately led to federal securities regulations and the beginnings of GAAP. But keep in mind, companies issued financial statements largely for banks and private lenders, not investors. And public companies could choose what to disclose and how to measure results. In the 1920s, the public capital markets grew, and with it, the demand for audited financial statements. Auditors began using professional judgment to decide revenue timing, and the Federal Reserve Board published uniform accounting guidance for banks and public companies. The CPA profession began to recognize the need for common audit practices, but there was still no enforceable revenue recognition standard. The 1929 stock market crash was the catalyst for federal oversight of public company reporting. It exposed the overstated profits, revenue manipulation, underreported liabilities, and aggressive or misleading disclosures. And of course, investors quickly realized that, in fact, there was no legal requirement that financial statements had to be truthful, which in turn led to public outrage and highlighted the need for standardization and comparability. In 1933, the Securities Act of 1933 was passed and required companies issuing securities to provide full and fair disclosure. In 1934, the Securities Exchange Act of 1934 created the SEC to actually enforce the reporting standards for public companies. That was basically the turning point. And the SEC now was on its path to standardize public company financial statements. The first chairman of the SEC was Joseph P. Kennedy Sr., appointed by Franklin D. Roosevelt. The SEC Commission's initial leadership had significant legal and regulatory backgrounds, and the chairman came from a business background. The intention was to bring strong legal oversight and enforcement capability to the SEC because the SEC's early focus was on fraud prevention, disclosure requirements, and market oversight, not detailed accounting rules. That shaped how early standards were developed, and consequently, Regulation SX, issued by the SEC under its rulemaking authority in 1938 and 1939, did not define accounting methods, only how financial statements should be structured and disclosed. It set formatting and disclosure requirements for public company financial statements. For instance, what financial statements must be included, how they must be presented, footnotes and required disclosures, and auditor report requirements. Today, Regulation SX still remains a key regulation for publicly traded companies, and it's updated via amendments, like, for instance, in 2020 when the SEC adopted amendments to the rules relating to business acquisitions and dispositions under Regulation SX. And by the way, the SEC later recognized the need for accounting expertise. By the 1940s, the SEC began hiring technical accounting staff and created the chief accountant role to interface with practicing CPAs and standard setters. Today, the SEC has a chief accountant, always a CPA, with an entire office of the chief accountant, as well as coordination with FASB, BCAOB, and the AICPA. So the modern SEC has legal expertise to enforce its rules and the accounting expertise to interpret them. The SEC could have written accounting rules directly, but it didn't. Instead, the SEC deferred to the accounting profession to create the accounting rules. It stated that the private accounting profession should create GAAP, and we, the SEC, will judge whether those standards are acceptable. A somewhat passive-aggressive statement. So in 1939, the Committee on Accounting Procedures, CAP, the Committee of the American Institute of Accountants, which would later become the AICPA, began issuing accounting research bulletins, ARBs, basically the first GAAP rules. They included early revenue recognition guidance, inventory valuation rules, and long-term contract methods, like, for instance, percentage of completion. But it wasn't all sunshine and roses. CAP was often criticized for the lack of a coherent conceptual framework, and it basically dealt with issues when it had to. In addition, it allowed alternative accounting methods, meaning that even when guidance existed, significant variations still remain. CAP issued 51 accounting research bulletins between 1939 and 1959, and eventually, due to increased pressures for more rigorous standard setting, the AICPA replaced CAP with the Accounting Principles Board, APB, in 1959, and the APB in turn was replaced later with FASB to establish systematic GAAP standard setting. To the 1970s, revenue recognition was guided mainly by a very general principle. Revenue should be recognized when realized or realizable. And that worked fine when companies mostly sold tangible goods. You shipped the product, billed the customer, and recorded the sale. But starting in the 1970s, business transactions got a lot more complicated. Software, franchising, real estate, and service contracts didn't fit in that simple model anymore. So the FASB and AICPA started issuing more specific guidance. And that's where this timeline begins. FASB Statement Number 48 was one of the first focused revenue standards and required companies to reasonably estimate customer returns. The idea was to stop companies from inflating sales at year-end by shipping goods that might come back later. FASB Statement Number 45 introduced guidance for franchise arrangements. Think McDonald's or Holiday Inn. These companies collected big upfront fees, but also promised ongoing support, training, and advertising. The standard said you could only recognize the fee as revenue when you've substantially performed your obligations, meaning you can't count all the income the day the contract is signed. FAS 66 established rules around transfer of risks and rewards requiring substantial completion and evidence that the buyer was committed. a forerunner to today's transfer of control concept in ASC 606. Now we move into the software era, late 1990s, when companies like Microsoft and Oracle were selling licenses, updates, and support packages all bundled together. The key challenge was, when is the sale complete? SOP 97.2 introduced the idea of vendor-specific objective evidence, VSOE, and companies had to prove they could reliably separate the value of each component before recognizing revenue. Otherwise, they had to defer it. This was one of the most detailed and complex revenue rules before ASC 606. From my own personal experience, I can vouch for how complex revenue recognition became. I worked for a software company that sold telecom hardware and software, and it was difficult to separate some of the components because you had to prove the prevailing price of the components, which had often not sold separately. By the late 1990s, the SEC saw too many earnings manipulations during the dot-com boom, premature revenue, channel stuffing, fictitious sales. So in 1999, the SEC stepped in with SAB 101. It didn't create new GAAP, but clarified enforcement, and it introduced the four famous criteria: persuasive evidence of an arrangement, delivery occurred, price fixed or determinable, and collectibility reasonably assured. This became the de facto rule book for over a decade. SAB 104 didn't change the principles. It updated the language to align with the newer FASB codification system and to clarify examples. So from 1979 to 2003, we had a patchwork of guidance: FASB statements, AICPA bulletins, and SEC interpretations, all addressing revenue in specific industries. The problem was that each industry had its own rules. That's why FASB and the AISB eventually said, let's start over and write one principle-based model that applies to everyone, which led to ASC 606, revenue from contracts with customers. And that's the standard we use today. ASC 606, revenue from contracts with customers, was issued in 2014 and became effective for public companies in 2018 and private companies in 2019. The core principles of ASC 606 is to recognize revenue in such a way as to show the transfer of goods or services to the customer in an amount that reflects what the company expects to receive. In other words, it's about when the customer gains control, not when the company delivers or gets paid. There was a major shift from the old earned and realizable concept to something more flexible and globally consistent because it aligned with IFRS 15 and is illustrated here with this 5-step model. Starting with the identification of the contract. That means we need a valid contract and not just any contract that must meet the requirements of ASC 606, including commercial substance, approved terms, identifiable rights and payment, and probable collectibility. In step 2, we identify the performance obligations, meaning each distinct good or service promised and separately identifiable. In step 3, we determine the transaction price, including the fixed and variable considerations, estimates, and potentially time value of money if significant. We then, in step 4, allocate the transaction price to each performance obligation based on the relative standalone selling price. And that can be quite complicated. What if you're bundling multiple components that include hardware, software, installation, training, and a discount on the next product release? And you don't really have a standalone selling price for each one of these goods or services. Finally, in step 5, we recognize the revenue when the performance obligations are satisfied. If this five-step model sounds familiar, it should. ASC 606 took the base model SOP 97-2, removed the industry boundaries, and made it apply to everyone. So in a sense, every company is now treated like a software company because multiple element contracts are everywhere today. In addition, ASC 606 expanded disclosure expectations significantly by requiring companies to disaggregate revenue by type, geography, or segment, describing performance obligations, timing, and payment terms, reconciling contract asset and liabilities, and explaining judgments and changes in estimates. In practice, issues arose pretty quickly, and several amendments to SEC 606 followed. First, there was uncertainty about which promises in a contract had to be treated as separate performance obligations, especially small and ancillary tasks. Accountants and auditors argued about the terms separately identifiable, and there was confusion about licensing terms and whether post-delivery shipping and handling was another service or just fulfillment. The ASU 2016-10 addressed that by letting companies ignore immaterial promises, that shipping and handling can be treated as fulfillment, and tightened the principle of separately identifiable and clarified licensing, for instance, to not split sales and usage-based royalties. ASU 2016-12 clarified collectibility and sales tax-related issues, and ASU 2021-08 focused on how to value deferred revenue acquired in an acquisition. Typically, though, those contract liabilities would be shown at fair value, which would be potentially different from the value under ASC 606. ASU 2021-08 introduced an exception so that acquirers now recognize and measure acquired contract assets and liabilities under ASC 606, not at fair value. Despite ASC 606, revenue recognition fraud still occurs. Here's some of the reasons. First, ASC 606 is principles-based, not rules-based. That's good because it allows flexibility across industries. But that same flexibility means management judgment is involved in estimating variable consideration, determining when control transfers, and allocating prices to performance obligations. Those are all areas that can be manipulated. If management wants to meet the numbers, they can make optimistic assumptions, and those assumptions often look reasonable on paper. The biggest driver of fraud isn't lack of rules, it's pressure. Executives are often under intense pressure to hit earnings targets, qualify for bonuses, maintain stock prices, or satisfy lenders and analysts. When compensation and job security are tied to revenue growth, the temptation to stretch the numbers becomes strong. Auditors test contracts, confirmations, and controls, but they're not in every transaction. They rely on samples and management's representations. Fraudulent companies often provide fabricated or falsified documents that appear legitimate. Remember, the audit provides reasonable assurance, not a guarantee of fraud detection. If management intentionally conceals fraud, auditors may not uncover it until after the fact. Today's contracts are often complex, multi-element, bundled, or with side deals that change the economics after signing. Companies may offer undisclosed concessions to customers, like you can return the goods anytime, or we'll ship early and you can pay later. Those hidden terms can make recognized revenue non-compliant. But auditors may not see the side agreements if they're off the books or informal. Of course, the company should have excellent internal controls, but internal controls are only as strong as the people enforcing them. If executives collude or override controls, Even the best designed systems fail. For example, channel stuffing. Shipping product early to inflate revenue can look like genuine sales unless auditors confirm with customers or analyze post-period returns, which of course they should. Audits happen after the fact, months after the transactions. By then, evidence may be incomplete, altered, or obscured. And remember, audits aren't forensic investigations unless red flags emerge. Many frauds like Under Armour in 2020 or Luckin Coffee in 2020 were detected through whistleblowers, analytics, or regulators, not the annual audit process. And sometimes fraud becomes so ingrained in an organization that employees don't even recognize they're doing it. I recall one healthcare company getting audited, and the employees would alter the documents that were provided to the auditors. Oh, this is how I was trained, they would say. That's how this process works, not understanding that they were committing fraud. Which brings us back to the main point. Revenue recognition is one of the largest areas where accounting fraud occurs. Fraud is not always easy to spot due to the complexity of contracts and the organization. However, it's important that you know the revenue recognition standard, ASC 606, and ensure that your company only recognizes revenue when it meets the requirements.